Hey guys, this is Shan from EXP, and I have my friend here, Jalal Farid from TD Mortgage, and thanks Jalal for joining us on this. Let me, I'll let you introduce yourself.
Hey, Sean. Yeah, thanks for having me. Really a pleasure to get to speak with you and to kind of talk about the current market right now.
Yeah, okay, Jalal. So there are a few concerns, and there's always questions that comes up about mortgage, right?
Yeah.
So as realtors, all the questions that we ask. So I have narrowed down some questions that I want to ask you, and then we could get some answers out there to kind of educate those people out there. So so Jalal, so tell me, what is your forecast for 2024?
So we are forecasting lower interest rates, ideally starting in more towards the end of Q2. We're going to start to hopefully see the Bank of Canada start to ease those interest rates. We do believe that the hikes are over, so if at the very least, rates should start to hold and stay steady, and then we'll start to see things declining towards the end of Q2. We have already started to see decreases in fixed rates, so that's a positive outlook that we're already having in the market.
Okay, okay. And do you think this is a good time for someone to get into the market and become a home buyer? Let's say if they're fresh out, first-time home buyers.
Honestly, it's a bit of a biased question. I do believe that any time is a good time to buy and get into the market. However, I do also believe that it's a very personal question, and it has to do with your own personal finances and your own stages of life that you're in right now,
Yeah.
right? Just because prices might be relatively high or appearing high or interest rates are high does not mean that you shouldn't buy right now. As we know, historically, real estate is an asset that you want to buy and hold, right? It goes through these cycles, it goes up and down, and that is part of the market if you're in it for an investment. If you're in it for long term, then you want to see what is that property going to do for yourself. If you're currently renting, how much are you paying rent, and can you afford the mortgage? Does it make sense for yourself and your current lifestyle?
Mhm. See, that's exactly what we tell our clients too, and I'm actively door knocking these days, and then this is a question that we get asked a lot. Oh, not at this time. Market's crashing. We are going into a recession, and then this is again at the end of the day, it comes to that personal. Is this the situation that you want to be in? Do you want to pay the higher rent, or are you okay to pay that mortgage and then to kind of upscale this? People are actually using this as an opportunity when the interest rates are high. People are jumping into the market, so they are getting the houses that they want at a discounted price or with very less competition, right? So it always comes down to their personal thing. Okay.
Yeah.
And then let's educate the viewers. What are the types of mortgages out there, and what are the pros and cons of it?
So there's a few different ones. You're primarily really going to see, like, are we talking about like a fixed versus variable
Yeah,
mortgage? Yeah.
that.
So that's pretty much it when it comes down to like the type of interest rates that you're going to get, and that basically determines whether you want as you've seen throughout the market, you're going to get those that booked a fixed rate in the midst of COVID at 3% or something nice and low, where that rate doesn't change and your
Mhm.
payments remain stagnant. So if it's going to be, let's say, $2,000 a month, then that's your payment for that length of duration of the term. So if you have for 5 years, that's a payment for 5 years. Whereas if you went with a variable mortgage, as you see, your interest rate is fluctuating. So you may have booked it at a low 2%, 3%, but now you're sitting at a high 6%. With some lenders, your payments may change. Sometimes they don't. At the end of the day, though, that interest is still being accumulated and being collected and coming out of your pocket. So it does have to be something that you as an individual are aware of and that you're comfortable with. So we have some investors today that are looking at going with a variable because they do believe the interest rates will drop. So they don't want to be stuck in a 3, 4, or even 5 year fixed rate, knowing that in the short near future, they will be able to save some money.
Mhm. So is it safe to say that, okay, it's best to go fixed and then not being on a variable at this stage where we are at, or does it also narrow down to the personal financial situation of yours?
It's going to come down to situational. So the first thing is that when you qualify for a mortgage, we have to do because the benchmark is no longer applicable. Our rates are above 5.25%, right? So now what they're doing is that basically they take your rate plus 2%, right? And they use that to qualify. So you have to also remember when you're qualifying for a mortgage, if your interest rate is 6% on a 5-year fix, you're qualifying at 8%. If you're doing it on a variable mortgage, the variable interest rate is most likely going to be higher. So let's say it's going to be at 6.5, maybe 7 for even numbers. You add 2 to that, you're now qualifying at 9%, right? So the first thing is, do you qualify, right? From there, you want to ask yourself, okay, are you comfortable with the risks that go along with the variable interest rates going up and down? They vary, your payments change, right? The interest rates can go up again, as we have just seen over the past 2 years, right? Whereas if you go with a fixed rate, you know that that is the payment that you're going to make. That is the interest rate that you're going to have for the duration of that term, like we just mentioned. But once again, if you lock yourself into a 4 or 5 year, 4 or 5% interest rate, and rates come down over the next 2 years, are you going to be okay saying, this is the decision that I've made, and you do have to write it out for the duration of your term, unless you break your mortgage?
That's a very good point. Yeah, that's very good. So let's say if we were to get a pre-qualified mortgage, and if you're booking, let's say, a pre-construction, how long does that pre-qualification last for?
I'm glad you asked this question. This is something that I'm a strong advocate for. I do love pre-constructions. They have their pros and their cons, and one of them leads into the pre-approval world. So generally speaking, and this varies from lender to lender, a pre-approval will be good for about 120 days. But a pre-approval is basically a blanket approval saying you, Sean, can go ahead and afford a mortgage of $500,000 based upon this set purchase price. You have not yet purchased anything, right? So in 121 days, this is no longer going to be valid, right? So we do have a lot of clients that go shopping for resale homes, and that's a great product for them to use. They go ahead and get the pre-approval. It's good for 120 days. If they find something within that timeline, excellent. If they don't, then we have to kind of refresh the application, ensure nothing has changed, and get them another approval, which is fine. Going back to the pre-construction world, we find that a lot of builders ask for a pre-approval, or the client asks for the pre-approval, and they provide it to the builder, and everyone is satisfied because you can afford the mortgage that you need, and it has all the information that the builder wants, but it expires in 120 days. So there's no real benefit to the client. The interest rate isn't booked. It's going to expire. Your finances can change, right?
That's really
we have here with my lender, we're able to book you what's considered to be a builder capped rate. The rate would be good for at least 2 years. It's a full approval. So your rate is booked. Your approval is in place. As long as you meet all your conditions, provide all the documents in place, there's not going to be any changes. So 2 years from now, if you purchased or 2 years ago rather, if you purchased a pre-construction that was to be built today, let's say November 1st, and you had booked the rate 2 years ago, you could have a 3% mortgage rate in a 6% interest rate environment.
Nice. Okay, all right. That's a very good point, because we get asked this question a lot, and having you here, this is an opportunity where I could get these answers for.
Of course.
And then I'm also lately hearing this from a lot of clients. So they have their interest closed, right? And then they're still getting calls from banks to make maybe lump sum just to kind of even out their payments, or to lock it into a newer interest rate that they're in, because whatever that the payment that they're making at this moment is only going towards the interest and not towards the principal. Can you elaborate a bit more on that?
Yeah, for sure. So this is primarily for clients that have decided to take a variable rate mortgage. If you obtain this variable rate mortgage about 2 years ago, your payment may have been $1,500.
Okay.
Right now, your payment should be maybe $3,000, because your interest rate was 2%. Now it's 4%, or 3%, 6%. Right? It's basically has doubled. So therefore, in all technicality, your payment has technically doubled. Okay. Right? Now, some lenders do it in a manner where, as interest rates go, and as interest rates increase, your payments will increase with it. So that $1,500 payment will go to $1,700, $1,900, all the way up until it keeps until the rates stop increasing. Other lenders don't do that, and they say that this is the payment you agreed upon. It's $1,500, and that's that. At the end of your term, you will be responsible for any additional interest rates or interest that has occurred. Or, of course, you can make lump sum payments, principal payments, increase your regular scheduled payments to offset those for you.
Okay. And then also you could also offset it by increasing the amortization, I'm guessing. Is that right?
Yes. So a few ways to combat it would be if you were, let's say you didn't want to refinance, you do have the option, dependent on your lender, to be able to move your variable mortgage into a fixed rate product. It's going to be based upon the current term remaining on your mortgage along with the current interest rates. So they're not going to be able to provide you, a 3-year interest rate that was 2 years ago at 3%, right? It would be in today's market, which could still save you, about 2% on your mortgage if that's what you benefit from. The second option would be to refinance. So if you find that when you are booking a new fixed rate, the payments just still don't make sense to you, it's because it's still structured on your current amortization. Right? If you had 20 years remaining, they're going to keep it at 20 years and make those payments work and let you know what those are. If that payment structure doesn't work for you for whatever the reason, refinancing is a great option. You can bring it back up to 25 years, 30 if needed, and decreasing those obligated payments and increasing your monthly cash flow.
Okay, fair enough. And let's just say another question would be, what would be the options for down payment? So there's 5%, 10%, 20%. So how could someone get into the market? Let's say they don't have money saved up, So what could be the options for them?
Yeah, so down payment is kind of a tricky one. It is something that you do have to come up with. There is a minimum of 5% down. So that is on the first 500,000, and anything additional or above it is 10%. So for example, if you're making a purchase of 500,000, if that is the purchase price, your minimum down payment is 5%, which is 25,000. Whereas if you went to make a purchase for 600,000, your total down payment would actually be 35,000, right? So it's 10,000 additional per 100,000. In terms of saving options, it really comes down to the individual to kind of come up with those funds, whether it be from your own personal income, investment streams, the bank of mom and dad, or whatever it might be to assist in growing those. You do also have your first-time homebuyer options with the RSP. There's the new first-time homebuyer savings account that the banks are coming out with to assist. So there's a lot of different options that you can use to grow your funds, but at the end of the day, it is ultimately up to you to start those savings. If that is a plan that you want, you can definitely reach out to me or your current bank in seeing how we can meet those financial goals for yourself.
Okay, fair enough. So let's just say, well, how do you guys base the income? So how much income is needed to buy, let's say, $1 million house?
It would vary, right? So it's kind of hard to say and just throwing out a number there for you. Roughly speaking, pre-COVID, you could look at something between 4 to 4.5 times an annual income on a conventional mortgage, but that is truthfully not the best way to calculate it. At the end of the day, what you want to do is that you want to take your overall household income and debts and divide them by each other to see what that percentage is. And that's how the bank is going to utilize your income versus debts, right? And it has to be a certain percentage and threshold to kind of qualify, right? Then you have to look at, does the property have condo fees? What are the heating costs associated with it? What personal debts do you have?
Yeah. Okay.
So to qualify for $1 million, it's not just simple as, oh, you need an income of, 400,000 or 500,000. It's what is, once again, your personal situation, right? What is your income? What is your spouse's income, if any? And do you have significant savings? Because we definitely have different programs available that can leverage that for you.
Okay, fair enough. And so another one question, what are the perks that, let's say, banks or even private lenders that would have for newcomers that's coming, because we have lots of migrants coming into the country, and then again, it's the dream for everyone to own a piece of land and whatnot, right? So what would be the perks that, let's say, banks provide or any mortgage gives for newcomers or first?
Of course. Yeah. So once again, it's gonna be dependent per lender, especially if you want to start talking about private. It's gonna be very different. But most big banks will have a program available for newcomers to Canada. First and foremost, you're going to get all the benefits of Canadians already. So if you qualify on a standard application, great. That's how you're going to be able to qualify. Aside from that, if you don't, let's say maybe you don't have established credit, but you've been renting here for 12 months. Well, we can use that, right? Or maybe you have a phone bill, right? We can speak to that in terms of the history. Furthermore, maybe you were, a professional back home. Maybe you were a doctor or a lawyer, and you're just going through certifications here, right? But your income right now, let's say, is maybe 50,000, and in 6 months it's going to be 100,000 once you complete these certifications. As long as we can speak to it, as long as we can prove it, we can actually leverage that. So as you may know previously, to qualify, you'd have to have somewhere between 39, 44% GDS, TDS. With this program, it can potentially allow us to go up to an 80% threshold, as long as we're able to case it and understand how is the client going to increase their income over the next, 3 to 6 months, right? What's happening? What's changing? Is this something that we can actually speak to? Right? And now that's very different from obviously saying, you were a doctor and you have to go through 2 or 3 years of classes here, right? That may not pertain directly to you. It has to be something within the short term that we can actually speak to. You're in school for, you're getting your master's, or you're in the doctor's program, and you'll be finishing in a very short term.
Okay, fair enough. So what would be a piece of advice that you could give to people to overcome this situation where we are in this bubble? So it could either be it could be the people that's owning the house right now, or someone looking to get into the market. What would be the piece of advice that you could give?
Honestly, don't give up. Like it's a big purchase, and I don't think people realize. Right. Yes, it's a Canadian dream. It's something that everyone speaks to. Your parents want you to buy your own home, but it's not like, a $100 item. It's also not, a $50,000 car, right? Especially here in the GTA, you're on average, you're looking, $700 to $1 million. It's a huge purchase, right? It's not something that you're going to overcome overnight. It does take time to accumulate the savings, to understand the process and the application. So truly, I would say just don't give up. If you're in the market, if you think you're going to be buying a home, if you want to figure it out, speak to your a financial planner, reach out to your bank, and talk to them and be like, this is my goal, right? The bank is here to help you and help you to achieve those goals, right? That's where we specialize to help you in.
Perfect. Thanks, Jalal. Thank you so much for filling us with this information, and thank you for taking your time. And guys, if you guys need any mortgage help, Jalal will be the guy to go to, and I will definitely include his contact info in there, and feel free to reach him out. Thanks, Jalal.
Thank you, Sean. Thank you for having me. Really appreciate it.
Thank you. I want to thank Jalal for this lovely information that he had shared with us. And if you guys have any questions in the future about your real estate needs, give me a call at 647-966-9396. That is 647-966-9396. And I'll be happy to help you guys with your real estate needs. Thank you.